Excellent. Well, thank you very much for your time, Manny. Just on Flagship and possibly even your background, maybe if we could just start off with a bit about yourself, how you came to be at the LIC, and maybe also just after that, in your own words, a bit about the investment objective and strategy.
I arrived in this country in 1994 and had a particular idea that of managing money and the markets that the approach would be suitable to, which essentially started in the high net worth space and obviously then transcended into institutional business. But in a highly regulated market like Australia, in order to get on approval lists and IPOs and asset consultants signing you off and research houses doing the work, you need to have a track record, which is the old catch-22 situation. Is if you don't have money to manage, you can't get the track record, and you can't get the track record, and they won't give you the money until you've got the track record. So one of the ways to get around that conundrum is to, in fact, talk to a couple of people, and clearly in South Africa, there were a number of people that knew me, but also there were some people here in Australia who liked what I had to say, that were prepared to back me. And so they put up what you might call the seed capital into Flagships in the early days. So we raised some money from individuals. It was an unlisted public company. And we used that to generate the initial track record to then leapfrog into asset consultants and the institutional space. Now, that unlisted public company, obviously, when you've got a number of shareholders in it, you've got to comply with the corporations law and disseminate information. And as people come in and go out, that paperwork and those requirements get really onerous. And the easiest way to deal with that is, in fact, to list the company. Because then once you disclose something to the market, it's deemed to be disclosed to everybody. Whereas if investor A wanted to sell, you need to give him every bit of information that had ever been disseminated about the company from day one, so that he could decide whether he was making the right decision or not. So, I mean, the ASX has got costs associated with, but in the overall scheme of things, it's actually a very efficient and cheap way to deal with your investors. So we then listed it, and that gave us the track record for the funds management business, and then obviously extended into other things, and the rest is really history. So that's how we got into Flagships. In terms of investment style, when I arrived here, my training was similar. I came from a broker. I was a senior partner in a broking firm that is now Merrill Lynch, South Africa. And I headed up the research department. And I was always of the view that if you were going to be a stock picker, a bottom-up stock picker, and you hang your hat on that in terms of that's the way you construct portfolios, there is no better training ground than actually the research department in a broker. They teach you the skills of how to analyze a company, what to look for, how to do the digging. Whereas the buy side tends to be more macro and top-down kind of training that people get. If you want to get training on analyzing companies, I believe the sell side is the best place to do that. And that's where I came from. So I had this idea of taking detailed forensic research into companies, and then clearly using that to strip out what was not deemed to be investment grade companies, to end up with a universe of what we would deem to be investment grade, and then to weight those in an appropriate manner in a portfolio, and that would give you outperformance. And the track record has proved just that. In all the various surveys that have been done ever since I've been in Australia, the investment process that we follow, which is in Flagships from day one, has put us in the top quartile of managers over whatever period you want to look at it, 1, 3, 5, 10, 20 years, you name the period, and we're in the top quartile. And in fact, last week on Friday, the Fin Review had an article quoting the top performing managers in Australia, and our mid-cap strategy was the best by a country mile. So the approach of picking decent companies by doing the forensic work definitely leads to outperformance if you do the work properly and you construct the portfolio properly.
That's fantastic. I suppose just on from that, I know the benchmark for Flagship is the All Odds Accumulation Index. With the rise in a lot of exchange-traded managed funds now, we've seen both passive and active managers be taken up quite exponentially, especially post the drawdown we saw in March. Could you maybe just tell me a bit about how the portfolio may differ from the underlying index and how you sort of attribute that outperformance?
As you quite rightly said, there's a lot of ETFs and a lot of managers that closely resemble the benchmark. I would say that, the benchmark is clearly a market cap weighted index, and we all know that. I don't think, these days, if you deal with a broker like yourselves, you can actually replicate the index at very little cost, or even zero cost. So you can get them, if you've got, sort of $1 million or a bit more, you get somebody to replicate the index at very little cost. So you can do it yourself, or you can go into an ETF, but then you're getting the index performance. And what we're talking about here is active management to give you excess performance over the benchmark. So we don't even look at, we're aware of what's in the benchmark. You obviously know what the big stocks are, and we see movements in and out of either the 20 or the 50 or the 100. But it is totally irrelevant to us. When I arrived here, I was quite surprised that one of the primary measures that used to be watched is clearly tracking error. And tracking error is just your volatility relative to the market. And people were trying to minimize that by getting closer to the index. And that means that you can't really outperform the index. So you're paying a guy active fees to give you a performance that's slightly better than the index. Well, I learned that clearly in the high net worth space, people are giving you their money to give them as the best performance you possibly can. And the interesting thing is that if you take the volatility of our portfolio, the standard deviation, it's actually lower than in the index. And right up front, people would not have assumed that, but that's what the data is. So we're giving people outperformance with slightly less volatility. And at the end of the day, that's what you need to do. Now, just because the stock is in the index, because it's got a market cap of $10 billion, doesn't necessarily mean that it's got the runway ahead of it to be able to expand its economic footprint. It doesn't necessarily mean that the business can continue to grow and give shareholders an acceptable return on their money year after year after year. So that's what we're trying to identify as companies that once you've put your dollar into the share, that the management team are able to continue to grow that business and give shareholders the return over time that they would expect over a 5 or a 10-year period. And just because the stock's in the index doesn't necessarily mean it's going to be able to do that. So in our opinion, there are a number of stocks that are in the 50 or the 100 or the 200 that we would not really want to own. We don't think that it's necessarily a quality business. Their balance sheet might be not what we would want to see. And from time to time, people in the industry will talk about lazy balance sheets, and in low interest rate environments like we got now, that discussion comes to the fore. And for us, it's actually nothing. It's nothing to do with the interest rate or the interest charge, because when things go south, like the Lehman Brothers collapse or at the start of the COVID, people that have strong balance sheets withstand that. That was what happened in the 1928 crash, 29 crash, is that if you had a well-funded business and you had a decent management team that could grow their economic footprint, the banks never came and knocked on your door and said, hello, that borrowings that you've got on your balance sheet, we don't think you can service it, or you've missed a payment, we want it back and we're shutting you down. So you have a perfectly reasonable business that goes out the back door because the bankers shut you down. Now, this COVID environment, the bankers have actually been the ones that have come to the party and helped everybody, which I've never seen before. So that's a total unusual event, but thank goodness they did, because it enabled a lot of people that we're going to go to the wall through no fault of their own to withstand all of this and come out the other side probably in better shape. But we want to see a business with a decent balance sheet. We want to see it able to grow its economic footprint. And we believe that this growth in economic value and growth in economic footprint leads to shareholder returns over the long term.
Fantastic. And just on that, I suppose, talking about the differential between the performance of the fund and, say, an index, I mean, often what we say is that it's a bit misguided, I suppose, in that there's fees associated. So often it will appear as though there's underperformance, but there's no transaction costs associated with the index. Could you maybe just tell me a bit about the fee structure? I know there's no management fees, but you have the performance fee. Could you maybe just talk me through the decision process there?
As I said, when we originally put this together to help us create a track record, the people that I was talking to said, okay, Manny, we've known you for a while and we think you're going to do a good job. If you can be rewarded when you actually produce performance, we'll be much happier with that model than having an ongoing management fee, which is the norm in the industry. So once you get established and people believe you're bona fides and you've got a team, they're happy to pay your management fee to do the work to give them the result. But when you fresh out the blocks, you arrive in this country, you talk with a funny accent, you're based in Queensland, and you're asking them to give you some money, having come from the sell side. They tell you, what are you, smoking your socks or something? No. There's got to be an incentive here. So the incentive was, okay, there's zero fees. Obviously, the expenses of the ASX, the company would have to cover, and audit fees. But outside of that, we will pay you when you outperform. So I said, okay, fine, happy. I believe that I know what I'm doing. So happy to go with that model. Then the question is, okay, so what is outperformance? And in a lot of funds, you have a look, it's versus the actual accumulation index that you think is the benchmark. And then there's a high water mark or whatever. And the investors we were talking to said, listen, we've got an alternative of putting the money in cash. We can't put it in the market. But let's to us, absolute return is what it's all about. They were saying, we're sick of going to a manager that's telling us they're outperforming and the benchmark has gone down 10%. And they've gone down 8%. To us as high net worths, as soon as you lose us money, that's underperformance. So they want you to beat the benchmark, yes, the market, do better than the market, and then they'll commit more money. But in terms of whether you've done a good job or not in their world, it's about not losing their money. So that's a given. Don't lose us any money and make us a lot of money on the way up. So that's where we came up with the absolute return performance fee, was that we would be paid nothing in a year where the portfolio went down. But when it went up, we would share in 15% of the outperformance.
Fantastic. And I suppose just on that topic as well, if we think about a lot of the dislocations that were seen early, mid last year, I suppose with the LIC market being, you've got a closed pool of capital and not an open-ended structure, we saw those discounts were quite widely blown out. And we tend to see that's exacerbated for funds that have, say, lower liquidity or market cap. Within about the past week or so, seen a lot of the larger LICs coming up with share purchase plans. What's your view on funds under management and I suppose the market cap bands that, say, you might invest in? Is there a particular mix there? Because I know, I suppose there's a bit of a flaw in that funds under management, you want to be growing that and the investment manager is taking a cut as well.
In the early days, I mean, obviously the stock markets go through cycles and we've seen, really movements up and down. And along the way, we did implement a share purchase plan, an on-market buyback as well, to try and absorb stock that was coming out of investors who were getting a bit nervous. And at the end of the day, it did nothing, because as soon as we either stopped that, the share price just went back to the discount. So you kind of fix it for a little while, but if it's an inherent problem, as you say, because of the liquidity or whatever, it is what it is. And when you throw money at it to try and stop it, in my experience, it might do it for a short term, but it's not a long-term solution. So then we said, okay, well, really what we're trying to do is over time to grow the FUM in this thing. Using it to buy back your own shares, yes, given the discount, it means that you're getting into the market. You're using that money to buy the same stocks at a cheaper price. I get that. But essentially, we wanted to continue to grow the business, so decided to leave it in. And also the support mechanism that provides was a short-term mechanism, as I said. So we didn't think that it was really worthwhile. A strategy that we came up, just about everybody has a DRP in place to essentially raise additional capital. And when you're paying a dividend yield of 3.5%, 4%, and maybe 30% of those people utilize the DRP, it can become a reasonable amount of money. But we decided to rather use that to buy up any shares in the market that people wanted to let go. So instead of issuing new shares, we actually bought in the market. And the upshot of that is that the liquidity, the free float on the market that's available that might be driving the price down at any one time has actually dried up. So we've dealt with the oversupply in a different way. It's taken us a little longer, but actually the shareholder base that we've got is a solid share base. And I actually think that that's one of the most important things, is that you get a quality shareholder base. And when you issue stock too often, by way of a placement or whatever, you get the wrong kind of investors in who really think they're there to make a quick buck. But what you want is solid investors who are there for the growth story and to get the dividends over time. So we think we've tidied up our register, that it's really in good shape. We've managed, the discount has been narrowing nicely. I think the discount is of the lowest that it's been. Yes, the way that we can grow the company is to raise capital, which is what some of the guys are doing. But unfortunately, I'm kind of old school, and I've made it clear that we will not do anything to the detriment of our supporters, which are our shareholders, as long as I'm around. And that means that there are some people who cannot follow a rights issue, and we had some shareholders who were resident in a country where getting capital out couldn't happen. So as soon as you have a float or you offer shares at a decent discount and they can't follow, they're disadvantaged. And I've said that people who are shareholders of ours, we will not hurt them in any way. So if the share price gets to a premium to the NAV, obviously we'll issue shares to new people at some kind of premium or at the NAV. But deep discount, I'm not interested, because there are shareholders who can't follow their rights and then they get hurt. And yes, they can sell them in the market, but they usually get taken to the cleaners anyway.
Yeah, spot on. That's a really nice capital management incentive. I mean, from what I've observed too, I think it's very important to have that stable and loyal share register. Also found things like communication to be pretty much integral. So, I mean, you're doing everything right on that front, and even just with the rebounds, seeing with the gap between the share price and the NAV, more broadly, I suppose narrowing and closing, but also just in particular when you take a look at Flagship, and I suppose the long-term performance is there too, and shareholders can recognise that. So yeah, that's fantastic. I suppose as well, just having a look at a lot of LICs are coming out with their half-yearly accounts now, and a lot are very dependent on the year-to-year investment income, and so a lot of the net profit and revenue is down versus the past year. Could you maybe talk me through a bit about the way in which you generate dividends for investors, be that through capital realizations or investment income from the underlying assets?
There's two sources of, obviously, income that one can distribute to the shareholders. One is the dividends you get in, and the other one is, as you say, the trading of the investment portfolio and realizing capital gains. We've always said that our approach is really focused on distributing the dividends that we get in to the shareholders, because as a growth style manager, not to say we're more interested because it's total return, but certainly our focus is on growing the portfolio and not so much a dividend play. So we don't see ourselves as a dividend hero or somebody that's got a high dividend yield and you buy it and you'll get your 6-7% ad infinitum. For us, it's about growing the dividend, and we've always said greater than CPI. Now, CPI is 2/5 of nothing at the moment, but certainly growing it at an acceptable rate for the investors over time, and we've managed to do that. But it's based on the dividends we get in. Now, in the COVID environment, people were keeping their cash in their businesses, so some of the dividends were either deferred or not paid, or some of them were cut back. And we decided at the interim, because our dividend that had come into the portfolio was substantially less, that we would maintain the dividend through the portfolio transactions that we had implemented, but pay it out as a special dividend. Now, I know that doesn't feature in the dividend yield that gets shown on the ASX or wherever, but to our shareholders, we maintained the dividend and we took some of it out of the capital gains that were realized. So their net cash in their pocket was the same. It was fully franked. But we wanted to show them how the dividend income had declined because of what was happening in COVID. But essentially, we would always look for our dividend to increase at a reasonable rate. And if the dividend income started to dry up, we've certainly got substantial retained earnings in the business, and we would be in a position to maintain that if the board decided to do that. But I think as a point of departure, we would be very loath to cut a dividend unless there was real trouble in investment land.
Fantastic. Thank you very much. And as well, just now on a forward-looking basis, what are your thoughts on this year to come? I mean, you sort of touched on it yourself previously with having those very low interest rates. The banks now are easing up with APRA relieving some of the restrictions on the free cash flow and distributing those dividends. So, you know, what do you think is going to be the next hot topic? We saw iron was rallying pretty hard at the end of last year. So what are your sort of thoughts around the next 12 months on the market?
Yeah, I mean, that's a really difficult question because I hardly ever talk about the overall market. I mean, we always talk about the stocks that we're in, and that's the starting point of our discussion. And over the next 12 months and over the next 5 years, the earnings and dividends in the companies that we're invested in is really looking good. Just to give you some anecdotal evidence, the support measures that the government put in place have resulted in, and we've seen it. I mean, companies that are selling caravans, or I mean, the high net worth people that are buying these fancy yachts, you got to wait 3 years to get one out of Riviera. You just can't buy one for love or money. The second-hand car market has gone crazy because everybody is traveling inland. So there's a lot of money out there because of the accommodation of the banks, as you pointed out, and because of the support by the government. So that's going to come to an end. But I do think that a lot of businesses have been able to replenish their balance sheets and get themselves into really good shape. They've all taken on technology that probably would have taken them 2, 3 years, 5 years to implement in the space of 9 months to get to their customers. That whole process has been accelerated. So if you are a manager of a business that is half decent in its approach to its customers and technology and its balance sheet and all those business things, you're coming out of COVID in exceptional shape. I mean, I know small restaurants here where I live who have never had as much cash as they've got now. Because if you think about it in simple terms, yes, their customers visiting their store or whatever have gone down maybe 20%. But they have managed to continue to talk to the bulk of them through technology or do home delivery or whatever it is. And then if you look at the cost of doing business, 30% is in wages, 20% is in rent. Wages has basically been paid for by the government. The other 20%, which is in rental you pay or various other things, the banks have given you a holiday for 9 months. So in cash flows out from every dollar you get in servicing your customer, half of it is going in your bank account, whereas before it would go to everybody else. So these guys are sticking cash in the bank second to none. So that flows through to the overall economy, and the companies that we're in have really been well-run businesses where the guys are aware of this. They've changed their business model. They've implemented technology to speed up the delivery or talking to their customers, or they're already in that space. And those guys are going to come out even better. So the growth rates that we're seeing for the companies is absolutely improved from where we saw it originally. And especially at the start of COVID, we were nervous as all hell about the growth rates for these companies. Well, it's turned out we've been wrong in most counts. They're performing better than we were expected. So in terms of our portfolio, yeah, we're still very relaxed about the next 12 months. In fact, we're quite delighted about where it's going to be. The question is, what is the multiplier going to be? What are the P multiples? Is there going to be pressure on the multiples down from 30 to 20 or 40 down to 30? That pretty much, I think, hinges on where interest rate policy is going to be and the whole accommodation by the government and the Reserve Bank and bankers at large. And when they start to put their foot on the pedal, it's going to be difficult to gauge. And when they do, that's going to have an impact on valuations. But we think that the earnings is going to get you to a point where that will have some impact, but it won't be material. So we're pretty relaxed over the next 12 months to 3 to 5 years, and certainly feeling a lot better about things than what we did 12 months ago.
Fantastic. Well, I suppose I'll frame the next question a bit more to your expertise, I'll get down to the stock level. But and it's quite interesting, as you say. I mean, the current landscape have seen quite a large blowout in multiples. So, you know, how do you think we go about navigating, you know, maybe possible value traps? And because the portfolio is quite concentrated, what would be, say, a couple of your high conviction picks?
So, two questions there. The first question was something that I was faced with. Must be 15 years ago. But we were faced with exactly that. It was you had the dot-com era where things were on 100 multiples, etc. So the question is, how do you not get caught in this? And we came up with an approach where we calculate for each of our investments every day, each of the stocks every day, an internal rate of return that we expect to achieve over the 5 years based on the share price of that day. And we weight the stocks in our portfolio according to a risk-adjusted internal rate of return. So in our portfolio, if you have a look at the December quarterly, you would have seen the CBA was our biggest holding, and then Hub was the next biggest. On each of those stocks, if you looked at the internal rate of return over 5 years, and clearly there's some risk adjustments that we put in with various risk metrics, but on a risk-adjusted basis, over the next 5 years, the Commonwealth Bank at the time that was run was giving us the best risk-adjusted return. So it had the highest weighting, and then followed by Hub and various others. So that's how we avoid that trap that you're talking about, is that if you don't bring back what you think you're going to make out of this, and it does hinge on the terminal valuation, I get that, and there's a lot of work that we do in science that we put into determining the valuation at the end of the 5 years. But you have to each day figure out whether that price plus the dividends you're going to get warrants paying the price you're doing today. And if it doesn't, then you don't own it, and we don't own it. So every now and then you'll see something go out of our portfolio, and people say, why did you sell that? It's still a great company. Yeah, it's a great company, but the share price has got up to the point where we think we're going to make no money over the next 5 years out of this thing, and we honestly can't own it. So that's how we avoid that trap in the way we put portfolios together. Now, in terms of some of the stocks, I mean, these are listed vehicles, and we've got to always be careful on information that we disseminate. So I can really only talk to what we have said. But in the last quarterlies, we highlighted two stocks, which was Nuix and Serko. Those were added in the quarter. Nuix was a recent IPO. We don't take all the IPOs. I mean, brokers like yourselves come to us and get really upset because we don't take everything. But we spend time looking at them, and if we haven't had the information for long enough, or we really don't like what we see, we don't take them. And those are two stocks that we did add, so they're recent additions. We think there's fabulous opportunities for both of them. Both they're technology players. One is in the travel industry, and the other one is in the data management industry, where they provide analysis for people that are in highly regulated industries like you and us and lawyers, etc. So both of them are technology players, but both of them are recent additions. And as I said, Nuix was an IPO that we took up.
Fantastic. Well, thank you very much. I think I've already probably taken up enough of your time, Manny. It was very nice of you to dedicate some time out of your schedule to have a chat. So I appreciate it very much.
No, it's absolutely my pleasure, and happy to talk to people like yourselves to try and explain to you what we do. It's not rocket science, really isn't. It's really just the simple basics. We want to invest in something to get a return at the end of the period, and we want to get some dividends, and we want to avoid the volatility that appears in the markets. And to the extent that we get that right, our performance continues to be there. And then we've got the support of people like yourself. So no, thank you for your interest. Happy to have regular calls, or whenever you want to chat to me, just pick up the phone and Boyd can arrange anything. But really, thank you to you and your firm for the support you've given us over the years, which has been immense, and we really appreciate it.
No, thank you very much. Cheers.